Welcome back. Time to get the day's business news with Owen. Hello again, Owen. So the Eurozone crisis back with a vengeance this Monday with that downgrade for France.
Yeah, absolutely. The market's having a very torrid Monday, Claire. Just before I show you the numbers, I found this just a little while ago. It didn't get cleared out over the weekend. This is Friday's Financial Times. We can get a close-up, really. We get a close-up there on that headline. Now, this is very unfair on the FT because it just shows how fast this Eurozone crisis has evolved over the last 48 hours or so. Their headline on Friday morning, ECB sees signs of let-up in debt crisis. And it's true to say that on Friday, before that downgrade, things were actually starting to look pretty good. We had decent numbers on the markets. We had some decent bond sales, decent demand for bonds in the Eurozone. And yet it all seems to have come crashing down with that downgrade, as you say, of the French debt rating. Let's give you the numbers on the Asian markets to give you a flavour of just how investors are reacting to this on Monday. It's the first full day of trade since that announcement late on Friday evening. The Nikkei closing the day 1.5% down. The Hang Seng and the Shanghai Composite still trading, but you can see deeply in the red there, around 0.8% down. One stock worth following as well this Monday, and one stock that will get an awful lot of attention is Carnival. They're the US owners of the Concordia ship, which of course sunk over the weekend off the coast of Italy. Now, already its share price was under pressure in the face of rising fuel costs. Also, the company announcing that it was forecasting lower revenues for 2012. So its share price on Friday had closed down around 2%. It's already lost a third of its value. Expect to see bigger losses, of course, in the wake of this disaster. There are various estimates about how much this will all cost the company. I would say at the lower estimate, it's going to cost at least $200 million for the clear-up, the cost of compensation and so on.
Now, getting back to that France downgrade, it had been expected, with even French President Nicolas Sarkozy trying to soften the blow by suggesting the loss of a golden credit rating would not be catastrophic. But the downgrade has serious implications for the future of the Eurozone itself, as Oliver Farry reports.
France's AAA downgrade was the most alarming signal yet for the troubled European financial stability facility. The Eurozone's second biggest economy saw its credit rating taken down a notch on Friday, along with 8 other Eurozone countries. It leaves France facing the prospect of higher interest rates and tightened credit flows. For the euro, it could seriously affect the servicing of member countries' debts. After France and Austria's downgrades, 4 Eurozone members retained their AAA status. They may now have to step up their guarantees on Eurozone debt to avoid a downgrade of the EFSF. That could deter outside investors such as China from buying bonds to help bail out those debts. Germany's finance minister said a strong political will across the Eurozone could pull the single currency through.
Markets also got used to the fact that rating agencies no longer necessarily share one and the same view. But really, more important than the daily ratings by markets are reliable politics mid and long term, and that is what we are indeed taking care of together.
France still has its AAA with the 2 other big rating agencies. It is attempting to raise up to 8 billion euros on a bond sale on Thursday, and Spain is also returning to the markets after a successful sale last week. The latest downgrades may now make takers on those sales more tentative.
Well, as we heard in that report there, of course, the 2 other big rating agencies, and it's worth remembering this, haven't downgraded France. And in fact, Fitch told us at the end of last week that they had no plans to downgrade this country. And yet, as we heard as well in that report, these 2 countries now, or at least France and the rest of its Eurozone partners, particularly the big ones, the AAA ones, they're no longer equal partners, particularly with Germany. In fact, France is really starting to decouple from Germany. If you look at their borrowing costs, for example, France on its 10-year bonds has a yield of around 3%. Not catastrophic when you compare it to countries like Spain or Italy. But nevertheless, it's starting to move away from Germany. You can see German borrowing costs are half that. German bond yields on their 10-year bonds, around 1.7%. The French pay nearly double that. And in fact, the irony is that in Germany now, investors now pay the government for the privilege of lending it money. That's how far through the looking glass we've gone through this whole crisis. But it remains that France really is no longer an equal partner between these 2 countries.
And if those borrowing costs continue to to rise, it puts further stress on public finances.
Absolutely. Here in France, of course, you're going to see the impact on that. Savers are likely to feel the pinch of that because that downgrade will be passed on to banks. The banks will be downgraded as a result of the country being downgraded. It means that they will pass on increased borrowing costs to customers, also to lenders and so on. And as we heard in that report there, French finances are a little bit in the frame right now. The French government has to find buyers for around 9 billion euros of new debt this Thursday. And remember that France has around 290 billion euros of public debt maturing over the next 12 months. Yes, it's a high amount. And yes, nobody's saying that the French will fail to find buyers to refinance that debt. But you can see the onward pressures of this downgrade. It just doesn't look too good right now.
Now, Standard & Poor's also said the European Financial Stability Fund's credit rating is also under threat. The bailout fund needs foreign investors from cash-rich countries like China to maximise its lending capacity. Earlier, we asked our Beijing correspondent Shannon Van Sant if Europe now looks like a less attractive investment.
Many investors are looking for countries with a AAA rating, and of course France's credit rating downgrade, as well as other European countries, endangers the credit rating of the European Financial Stability Fund. And that's precisely at a time when the fund needs and is looking for investors like China to invest and to help Europe out of this financial crisis. So I think many investors right now, they're looking for safer places to put their investment, but at the same time, investors like China, they don't want to see Europe fail, but they also want to minimize their risk.
That was Shannon Van Sant talking to us a little earlier from Beijing. So the Eurozone looks like a pretty risky bet now for many investors, particularly bonds, distressed, traditional stocks, also quite difficult to pick. So what about water? Its dwindling supplies mean that demand is growing for it. And a lot of investors now say it's one of the only safe remaining investments. But it's also fairly volatile in many countries, triggering riots, as Siobhan Silk reports.
The economic crisis has proven even investment vehicles once perceived as bomb-proof, like bonds, aren't so stable. Some investors are eyeing up another opportunity: water.
We've seen in the last 25 years water's reached the same price level as that of oil, but with much less risk and less volatility.
Demand for water is on the up and up around the world. As the population rises, so too does the draw on global water supplies. From 7 billion people today, the Earth's headed for 9 billion in 2050. Financial gains through water companies may be modest, but they've ticked up gradually, providing solid returns. The American water company, for example, saw its share price rise 30% over the last year. But critics say private companies shouldn't make a profit on what should be a basic right. Mexico and Bolivia have seen violent clashes over water rights. In Europe, trade unions have come out against privatisation and many cities are resisting it. After many years run by a private company, the city of Paris's water system reverted to public ownership. Last June, Italian voters overwhelmingly rejected privatisation. Investment managers say it's in the interests of water companies to put ethical practices into place.
From our point of view, companies that launch a product with good practices and work well with their environment have a better chance of being profitable.
Despite the controversy, private companies continue to pour money into water, the one commodity no one can live without.
Right, thanks very much, Owen, for that look at the day's business news. And you, of course, can follow Owen on Twitter. That's it for now. All the latest headlines coming up in just a few minutes. Don't go away.